Okay, so Alan just wanted me to hop on and talk a little bit about charitable remainder trust and how those work and the different options that you have with the charitable remainder trust. So essentially what happens here is you would place assets into a trust. The income tax would be tax deferred until the assets are distributed from that trust. And then you would have a set term of years or a lifetime payment period where distributions are made from the trust to a non-charitable beneficiary. And at the end of that term, whatever is left goes to a charity. So that's why you get the favorable income tax treatment. It's not technically a tax exempt entity, but it's more of a tax deferral entity. But the income tax benefits can be pretty nice by spreading out income over a number of years. So when you contribute assets to this trust, there are certain rules that you have to follow. Basically, you have to set the payout percentage so that, at least according to the IRS, the actuarial expected value based upon present value factors that the charity is expected to receive at the end of the term has to be at least 10% of the assets going into the trust. So if you contribute $1 million into the charitable remainder trust, whatever the payout percentage is, whatever the term is, what is expected to go to charity would have to be at least $100,000. Now, that doesn't mean the charity has to actually receive that. It's just that's the expected amount based upon how the IRS tells us we have to calculate these. So a couple of different options here. You can have a CRUT, which is a charitable remainder annuity trust, where you just have a fixed dollar amount each year that comes out of the trust to the non-charitable beneficiary. At the end of the term, whatever's left goes to charity. So it might be a 20-year term where you would have $100,000 going in, $5,000 a year comes out for 20 years, and then whatever's left at the end of that term would go to the charity. The benefit there really for if the assets are appreciating inures to the charity because that dollar amount is going to be flat. Now, you could also do a charitable remainder unit trust where you pay out a fixed percentage of the value of the trust each year. So that way, as the assets grow in value, the unit trust payment also grows in value. So the benefit then inures to the non-charitable beneficiary. The percentage of payout for the CRUT has to be at least 5%, and it can't be more than 50%. And then you also have to satisfy the rule that actuarially the expected value going to charity is at least 10%. So a variety of different payout methods that you can use. This can be based upon a term of years for all the way up to 20 years is the maximum term of years. You could base it off the lifetime of yourself, the lifetime of another, multiple lifetimes, so a joint life expectancy, a joint and survivor CRUT would work. You could also do for the longer of a term of years or a lifetime payment, or the shorter of a term of years or a lifetime payment. So a lot of flexibility as to how you want to structure it, and depending on the results you would like to receive, you can structure the NIMCRUT or the CRUT in that way, and we'll get to some of those different scenarios in a minute. Now, as far as the income tax treatment goes, as the assets go in, there's no tax as they earn income until the assets are distributed. And it carries out the income on a worst first basis with those distributions. So if the trust has ordinary income that's been built up inside the CRUT and not distributed, that ordinary income comes out first, followed by capital gains, followed by maybe principal is the last. So there's different tiers of income that comes out. Ordinary income, maybe depreciation recapture at a 25% rate, a capital gains rate, and then principal. You also might have 199A income layered in there somewhere. That is another tier that's just recently developed as a result of the passage of the Section 199A 20% qualified business income deduction. Now, we did talk about the deduction, or at least the actuarial value of the remainder interest has to be at least 10%. And because of that actuarial being expected to go to charity, you get an income tax deduction when you contribute assets to the trust. So not only do you get the benefit of tax deferral, you also get the benefit of an income tax deduction. So how can this be structured? We mentioned there's different flexibilities. So you could do a term of years, and here are the percentages based upon those terms of years for a charitable remainder unit trust. You could do it on the life of two people. So two 40-year-olds, 5.13% would have to come out each year to maximize the value coming back out and minimize what's going to charity to just 10%. So you can see where we can run into issues where you can't satisfy that the payments have to be at least 5% each year, and all the way up to 50% each year is what the CRUT percentages can be. You can do it on the life of 3 people, but again, you might run into issues where you cannot get at least 5% out and leave at least 10% for charity in those situations because of the long life expectancies of the life of 3 people. So interesting that you can do this not only for one person, but multiple lifetimes or terms of years. So a lot of flexibility in how the payout structures work. So practically, how can you use a charitable remainder trust? Well, one of the most common tools is really just to defer income out over a number of years. And this could become important, particularly if we run into compressed income tax brackets, or if we have a surcharge on adjusted gross income like has been proposed. So if you have AGI of greater than $5 million, there's a proposal out there that would apply a surcharge of 3% an excise tax on income in excess of that amount. So one thing you could do is if you're expected to sell a business for a large gain, you put it in the charitable remainder trust, you sell it under the charitable remainder trust, and then you spread that income out over 20 years by distributing X% each year from the charitable remainder trust and recognizing the income as it's distributed. So it almost works equivalent to like an installment sale in a way where you can just spread out income over a number of years. So we might see charitable remainder trust used for that purpose coming up. One thing that we've done for a recent client is he came to us with the idea of he wants to give $100,000 to each of his children, but he didn't want to give them $100,000 outright. It wanted to be structured in a trust where they would only get a certain percentage each year, and they could control and manage the investments, and he wanted to provide them with a benefit to where if the investment assets grew, the amount that they got would also increase, to just introduce them to how to manage assets and how to be responsible. So we recommended the charitable remainder trust in that situation, because then he wouldn't have to tell them that I drafted this trust that restricts you from receiving assets. He could tell them, this is a requirement of the trust to have this type of structure and to give, the type of benefits that I want to give to you. So what we did is we gave him different options. So there are the ages of his kids, 50, 55, 40, 48. So we said, look, you can maximize the charitable deduction benefit, maximize your benefit to where the minimum amount's going to charity based upon the lifetime of the beneficiaries. So a 55-year-old would have 11.84%. A 50-year-old would have 9.64%. The 48-year-old would get 8.96%. The 40-year-old would get 6.92%. The other option is maybe you just equalize the amount and you get 6.92% for everyone each year. And in that situation, here's going to be the value of your charitable deduction. Obviously, since we're below the maximum amount for the 55-year-old, that charitable deduction, so the amount that's expected to go to charity, increases. So he gets the $21,000 deduction there. Or we could just do a 20-year flat term. Everybody gets 10.8%. You get a $10,000 charitable deduction for each contribution. So this worked out well. The client liked it. The kids liked it. They got a nice benefit and the ability to manage and control assets and receive stuff back each year that they could spend for living expenses. Now, another interesting one is the flip NIMCRUT. This gets a little bit more complicated, where you base the language of the CRUT to say, instead of just automatically distributing out 6% each year or whatever the percentage might be, the CRUT will distribute out the lesser of its net income or the 6% per year payment. And the benefit there is if the trust doesn't receive any income, then it doesn't pay anything out. So all that income remains in the trust and is deferred all the way up to what the 20-year term, if you want it to be that way. So how do we control the income? How do we block the income? Well, to measure the income, it's based upon fiduciary accounting income, which is different than taxable income. And under the fiduciary accounting income rules, which are state law based upon the Principal and Income Act of the applicable state where the trust is situs, most states provide that if you have an entity, then the entity blocks the income, and income is only received by the trust when a distribution is made. So you take your income producing asset, you put it under an LLC that is owned by the charitable remainder unit trust. When you want to make a distribution out of the charitable remainder unit trust, you make a distribution from the LLC, which triggers income, which then distributes out amounts to the beneficiary. The benefit of the NIMCRUT too is that each year, whatever payment that was supposed to come out, so if it was a 6% unit trust, that's stored and banked in a makeup account, and it's made up in future years when the income is sufficient to trigger up that makeup account. So if we wanted, let's go through an example where we have $100,000 in the CRUT, there's no income, so $6,000 would be stored in a makeup account to be distributed in later years. In year 2, there's still no income, so another $6,000 goes into the makeup account. So now there's $12,000 sitting in that makeup account. And then in year 3, we make a distribution from the LLC of, let's call it $18,000 to make the numbers work out. So the distribution would first satisfy the 6% payment that's required to be made this year. And then since there's still income left, it can look back to the makeup account and go ahead and distribute out the full makeup account as well to satisfy what should have been paid out in former years when there was no income. So it's a nice way to really control when income comes out and when it's taxable and when the non-charitable beneficiaries get the benefit. Now the flip, what does the flip mean? You can have the ability to have a triggering event which would convert the NIMCRUT, the net income with makeup charitable remainder unit trust, into just a normal charitable remainder unit trust, where it would just pay 6% or whatever the percentage is each year, regardless of the level of income. The benefit there is you might run into situations where the State Principal and Income Act doesn't allow you to make a large distribution. And if you make a large distribution, it might be deemed principal in later years. And therefore, you can flip to a regular CRUT, just distribute out the 6% and kind of dip into those last remaining principal amounts in the final years of the charitable trust. So a couple of different triggering events that can occur here. We had them listed on slide 13. Divorce, marriage. The one that we like to use is the sale of a non-marketable security. So you have the CRUT just own an LLC interest, and whenever that LLC interest is sold, it can flip to a regular CRUT to just provide the flexibility. So what does this structure look like? Here is a chart of one that we have done for a client. We have ABC LLC down here. It was expected to be sold for a large gain. So well before the sale occurred, well before we had a binding sale, we set this structure up. Fortunately, it was all under a dynasty trust, so we didn't have to worry about estate tax issues. All outside of his estate. The dynasty trust specifically allowed for the curation of this NIMCRUT, so we didn't have to worry about fiduciary issues or gifts by beneficiaries. So we had the dynasty trust set up an LLC to form the alpha and beta flip NIMCRUT. They formed a partnership with the two of them as the blocker entity, and then ABC was held by this blocker entity. So ABC sold for a large gain. There was, let's call it $20 million of income on the sell. So instead of the income all flowing out to the grantor of the dynasty trust, it was held up here under the NIMCRUTs. So it's all sitting in this blocker entity. It's all invested in the market in marketable securities now, and no income has come out for the last 4 years. Now, if they do want to get income, they simply make a distribution from this blocker entity to one of more of the NIMCRUTs, and then that triggers the income under fiduciary accounting law, and then the trust would then distribute out whatever's in the makeup account and whatever percentage should have came out in the current year to the LLC, which can then flow up to the dynasty trust and out to the beneficiaries. We also have the non-marketable security here owned by the NIMCRUT. So if they ever wanted to get away from worrying about net income, or if they just wanted to flip to a regular CRUT, simply sell this LLC, and that triggers the conversion to a regular CRUT. So what about numbers? How does this work out economically? Well, we ran some numbers on this, and in this scenario here, we have the NIMCRUT. And in this scenario, we said, they're going to allow 1% to come out each year, even though the trust distribution percentage is around 10%. We're going to keep the other 6% invested in the blocker LLC and not trigger that until the last year of the NIMCRUT. So we put $1 million in. We only had basis of $200,000 in the asset. It's sold, which would normally trigger $800,000 of capital gain. But in this case, it's all deferred under the NIMCRUT until it comes out. So in year one, we had a 1% distribution, $10,000 comes out. You pay taxes on that amount. The net goes to the family. And that's just stored over here in an account that grows at 6%, so we can annualize the numbers and then see how it turns out at the end of the 20 years. By putting that money in, that $1 million, the client received a charitable income tax deduction of $100,000, which resulted in a benefit in dollars of around $52,000 based upon their income tax rates. So then each year, 1% comes out. The remaining stays into the charitable remainder unit trust. And then in year 20, we make a large distribution from that blocker in LLC, triggering the makeup account, triggering the distribution. We do have a large gain at that point in time, but we have deferred that over a long period of time, 20 years, so the client can save money and be prepared for that. And so then the charity got around $240,000 and the client got around $3.1 million in total after the 20 years. So how does that compare to other scenarios? Well, if they just sold the asset, invested the $800,000 in the market at the comparable rate of return, they would have only had $2.6 million. So the tax deferred growth here actually gives them better off, even though a small amount goes to charity. What if they put the money in an account and then tried to make charitable deductions each year so they could have the same charitable benefit, but also not have to worry about the NIMCRUT structure? Well, in that scenario here, only $2.4 million. So you can see the difference that the NIMCRUT could make. Even though amount goes to charity, we get a nice benefit to the family. How does this compare to just a regular old CRUT? Well, when we look at this, you can see here that the NIMCRUT and the ability to defer the assets and wait until the final years of the trust to distribute that, let it all grow tax-free, has a nice benefit over using a regular charitable remainder trust or just no planning at all and investing and paying taxes as you normally would. So what are some other benefits here? Well, with the change in the IRA distribution rules to say that everything has to come out within 10 years, a lot of people have proposed using a charitable remainder trust to try to mimic the life expectancy payouts of the stretch IRA. So you would have the IRA payable to a charitable remainder trust, which would make payments out over a beneficiary's lifetime. And then a small amount would go to charity at the end of the years. So we ran some numbers, compared that. What if the assets come out under the 10-year rule versus what if we have a beneficiary of the IRA be the charitable remainder trust, which would then distribute assets out over the lifetime of the child. So under the 10-year rule here, we have the IRA balance growing tax-free at 7% for 10 years, and then distributed out to the beneficiary, large income tax payment. The net to the beneficiary there is around 1.2 million. He invests that money at 6% growth, and at the end of 20 years, there's $2.2 million in this account balance, assuming that he doesn't spend it all. If we have a charitable remainder trust, 20-year term, so try to mimic the life expectancy payout of the child, 10.87% comes out each year. At the end of the 20-year term, $450,000 goes to charity, and 1.9 goes to the beneficiary. But instead of getting a large lump sum payment at the end of 10 years, he's got a nice benefit of around $100,000 each year for 20 years. So it's not quite as good as the 10-year rule, but some clients prefer it just because the beneficiaries get less money out. It's more controlled, and it can work out well to try to mimic those old stretch IRA rules. So that's the stretch CRUT for use in an IRA. So just wanted to cover that briefly. And we have some other slides comparing the accumulation trust where we have the 10 years, and then the charitable remainder unit trust where the IRA is left to the CRUT. So Alan, I'll kick it back to you now and let you continue with the show, or maybe this is the end of the presentation. And if so, I hope everyone enjoyed it, and feel free to email any questions that you might have to me or Alan. My email is Brandon, BRANDON, @gassmanpa.com, and we'll try to answer the questions that you do have. So thanks very much for listening, Alan. Back to you.